Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Hey, listen, we got a big drop of economic news on the U.S. economy today. Applications for U.S. unemployment benefits rising to the highest since June, adding to evidence that the labor market here in the U.S. is cooling. Yet hiring plans falling to the weakest level for any August on record in data from outplacement firm Challenger Gray and Christmas, going all the way back to 2009, while intended job cuts rose. And then, Tim, we also got a read on the service side of the U.S. sectors. U.S. service providers provided expansion in August at the fastest pace in 6 months, on the sharpest acceleration in orders in nearly a year. That wasn't the only thing going on.
No, it wasn't. President Trump's pick for Fed Governor Stephen Miran up on Capitol Hill today, taking questions from members of Congress, including when it comes to Fed independence.
I couldn't be more in agreement that independence of the central bank is of paramount importance for the economy, for financial markets, for the long-run stewardship of the country. All of those are completely I'm in complete accord with. Look, the president nominated me because I have policy views that I suppose that he liked. If I'm confirmed to this role, I will act independently, as the Federal Reserve always does, based on my own personal analysis of economic data, my own personal analysis of the effects of economic policies upon the economy, and act based on my judgment of the best economic policy possible.
All right, that was President Trump's pick for Fed Governor Stephen Miran up on Capitol Hill today. Bloomberg's Michael McKee is also in the nation's capital there for the hearing. He's Bloomberg TV and radio international economics and policy correspondent, joining us from that said news bureau by Bloomberg News in D.C. Hey, Mike, I got to ask you, at a moment where it feels like there's a lot that feels so important for the economist in you, for the monetary policy person in you. We got readings on the labor market, on the U.S. economy, the hearing of Stephen Miran. We've got pressure on Lisa Cook continuing over at the Fed. What's really so important right now when it comes to the kind of economy and the monetary policy outlook?
Well, it depends on whether you're talking short-term or long-term. Short-term, the question is, what is the Fed going to do on September 17th? And today's ADP number, which you didn't mention yet, 54,000, lower than anticipated, is a suggestion that the Fed is going to be on track to cut rates, because they've been concerned that low employment and any rising unemployment would be a sign the economy is slowing down, that they'd want to get ahead of by cutting rates. ADP hasn't always been completely reliable, but the Fed, several Fed officials have said they're looking at that more closely these days because of the questions about the revisions to the prior NFP reports. So on a short-term basis, I would say that, and the fact that in the ISM services number, the employment numbers were still very weak. Longer term, it's the Lisa Cook situation that worries people, because if the judge, in her effort to try to stay on the Fed, says she can be fired, or if an appeals court says she can be fired, and Trump immediately moves to replace her, even though her case has not been adjudicated yet, then there's going to be some concern on Wall Street about politicization of the Fed. So we got the latest filing from the government in the Cook case today. The judge could decide tonight, could decide tomorrow, and that'll be the next important step for the longer run.
Is she working right now at the Federal Reserve, Mike? Do we know that? I know there was some confusion about this last week and even early this week.
It's our understanding that until the judge rules otherwise, she is still employed by the Fed, and she is still working, although working from home, we understand. But she hasn't had her job or her electronics taken away, so she can still participate. And if the judge lets her, she would be attending the September 17th meeting and voting it.
If she doesn't attend it, can she still vote for policy that day?
No, you have to be there to vote. And the thing about the Fed governors is there's no alternate. If a voting regional Fed president can't make it, then there's an alternate voter for them. But that would just be one fewer vote. And the question is Stephen Miran going to be confirmed? Because that would be one fewer vote as well if he's not confirmed in time.
All right, so let's go there. I mean, do you think Miran's going to be confirmed? And what will that mean in terms of the composition of the Fed?
He'll be confirmed. The president has said he wants him confirmed, and Senate Republicans generally do what the president wants. The only question is sort of technical. Can they get him through on the through the floor, given the calendar that they have? They have a lot of nominations backed up, and they'd have to move some things around. But it probably is going to happen. Now, the question is, what kind of reception would he receive, and what impact would he have? He was not well received at all by Democrats today, who pointed out the contradictions in his testimony, that he said he's going to stay on the CEA, even though he's said nobody should go back to their government job for 4 years after leaving the Fed, and after he criticized Lael Brainerd and Austin Goolsbee for going from a Democratic administration to the Fed and called that sinister. On the Democratic side, he hasn't got any friends. And then in his report on reforms that should be made to the Fed, he not only criticized Brainerd, but he criticized Mary Daly and Austin Goolsbee. And so will they be very friendly when he shows up?
Can't wait for Thanksgiving dinner when they all get together around the table. Should be warm and cozy.
It's just like I don't even know where to go from there. I do want to talk a little bit more about this hearing, though, Mike, and the idea of independence of the Federal Reserve was certainly dominant in the hearing today. And I'm wondering what the contradiction is, or maybe you can explain the contradiction in saying that like being independent on a body while retaining a job at the White House. How is that actually possible?
I think that's a question that answers itself, Tim. There's no real way to separate the two things. And I don't think anybody, even if he didn't say he was going to keep the job, was going to think that he would be an independent voice. As he noted, the president picked him because he has views that he likes, and while he will bring his own views and be independent in making his decisions, his views align with the president's. So he's going to be a reliable vote for a rate cut. It's really just that the idea that he would stay on even in an unpaid role as an employee of Donald Trump while he's on the Fed. It's just kind of a blatant hypocrisy, but that's kind of the way Washington's been working lately.
Mike, what did you make around the question and answer portion that focused on the former Federal Reserve Chair Arthur Burns and the idea of Fed independence and stagflation and presidential involvement during Arthur Burns' tenure, and the way that Miran handled that line of questioning?
Well, they were obviously trying to trap him into admitting that because the Fed was influenced by Richard Nixon in 1972 and they kept rates too low for too long, that would happen again. And of course, after 72, we got the great inflation of the 1970s. Miran tried to tap dance around it. I wonder how much relevance it has anymore because a lot of the people who were on that Senate committee probably weren't born then and so don't remember it. So at this point, it's ancient history. It is a cautionary history that Fed officials are very aware of, but I'm not sure it scores a lot of political points.
All right, we're going to leave it on that note. Hey, Michael McKee, thank you so much. I really appreciate it as we get ready for that monthly jobs report out at 8:30 a.m. Wall Street time tomorrow. Mike, of course, will be all over it with the team. He is international economics and policy correspondent at Bloomberg TV and Radio. I should point out that Fed Bank of New York President John Williams has said his forecast is that it will become appropriate to cut interest rates over time without clarifying the timing or pace of such moves. We know as head of the New York Fed, that voice is certainly an important one.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right. Well, people running with Techtember, they're also running with buy now, pay later. It seems to be everywhere nowadays. Companies, including Affirm, Afterpay, Klarna, have all brought installment payments into everyday life, while big banks and tech firms are also now racing into the space. It's getting a little crowded. So with the market growing so rapidly, there are obvious concerns over whether BNPL is adding a new layer of hidden leverage to the economy, giving online shoppers an alternative to more traditional financing, such as credit cards and bank loans. Data about BNPL usage, it's kind of limited. And those firms have so far resisted sharing a lot of information. But we wanted to know more. And this person, our next guest, knows a lot about the space. Here to talk about all of this, great to have with us the founder and chief executive officer and the $29 billion market cap company Affirm. Max Levchin joining us today, I believe from San Francisco. How are you?
I'm great. Enjoying this nice warm September.
It's a thing. Talk to us about, first of all, just big and broad, especially on a day when we're getting a lot of economic data. We're waiting for the monthly jobs report, trying to figure out what's next in terms of the U.S. economy. You see a lot when it comes to what consumers are up to. How would you describe the consumer today?
The Affirm consumer, that is the folks that we approve for transactions, and each transaction is separately underwritten. So we do have a very discerning eye as we underwrite these loans. They're doing great. They are shopping. Demand for our product is accelerating. We just posted another accelerating fourth in a row quarter of gross merchandise sales. They're doing really well. Repayment is really strong. Credit is steady to improving. And so we lend to a huge percentage of U.S. population, so you could infer from that U.S. consumer writ large is doing well as well. So I think the rumors of the American demise are greatly exaggerated. That said, we continue to watch every metric we can all the time because that's what our job is.
Are those metrics stronger now, Max, than they were, say, a year ago?
Again, from Affirm's point of view, we really are firing on all pistons. Our ability to serve folks has improved about 20% year over year. That's measured in transaction frequency. Our user base grew about just north of 20% as well. So consumers are joining us. Our user active acquisition has accelerated for the sixth quarter in a row. So there is a meaningful secular shift from credit cards to Affirm. So I think, again, within our ecosystem, every metric looks very good and better than last year.
Can you talk a little bit about what transactions Affirm customers are using the payment system for? Are they using it like they would use a credit card right now? What's the typical transaction? What's the transaction size?
That's a great question. And it's a little bit differentiated between players, so I can only speak to us. The average ticket for us is just under $300. That should tell you a lot. So everything from a truly considered purchase, like a nice bicycle, maybe a couple $100, all the way down to a large party supply, maybe a couple $100. Those are sort of the bookends. We tend to believe that really, really low ticket items, $20 is just too small of an amount to finance with Affirm. So we have a notion of, where we start trying to tell our consumers, hey, this seems like a good idea to be a cash transaction. But generally speaking, because the product we offer is just so much better than credit cards for the end borrower, we're very pro idea that Affirm should be used in place of credit cards, full stop. If you think of it very quickly, it is an obvious idea. So we don't charge late fees. We don't compound interest. We don't do deferral or any of the sort of gimmicky things that look too good to be true because they are too good to be true. So it is an honest financial product that really helps the end borrower get full grip on their finances and not get into trouble, not get over their skis. So directionally, the more they use Affirm for everything, I think the better off the consumer is going to be. That said, the current average is $297, I think.
How often does somebody, though, miss a payment or they're late? And then what happens as a result? What kicks in? I'll be honest, I'm not a huge user.
Well, I mean, have you ever used it?
I think I've used one of them, and I can't remember once because I was curious about it, and I set it up so things just got paid, and it was like 3 payments or something because I was curious about it because we talk about it all the time here. Grew up where you could put stuff away, stuff on layaway. So it's interesting to see the evolution. But I am curious, Max, how often is it that somebody is late and then the terms start to change? And, this is a business, right?
So that's actually... Thank you for that prompt. That is, let me try to make if there's one thing I can make clear in this conversation, I just really want to hammer this one home. Nothing will change. Terms will not change. Fees will not appear. Interest will not change. No dollar amounts will change if something happens and you can't make your bill on time. The fundamental promise of Affirm is what you see is what you get. Mm-hmm. When you're borrowing $500 and you're committing to paying, let's say, another $25 of interest, if you cannot make it on time, it will still be $525. There will not be a penny more. If you prepay and pay us early, that interest amount will come down. So it is a profoundly pro-consumer product. That's it. I just wanted to make that very, very clear.
Yeah.
We are a better financial product. About 98% of our consumers are never late, never in default. And so it's fundamentally extremely, extremely high probability of none of that will ever happen to you if you're within the Affirm ecosystem. When folks are delinquent, which is a fancy term for late with their payment, we'll reach out to them. We use all sorts of digital channels to get in touch with them. We'll remind them. Vast majority of folks that are late are actually what's called sloppy payers in the industry, where they say, oh my God, I forgot to set the auto pay. Thank you for using that feature if you did. And they cure it, and so it goes. And so that the reason we don't charge late fees is because for folks where they really cannot, something happened and they lost their job or something happened, they're not going to pay you any faster if they have no means of paying you back. The ones that are just stumbled somehow and forgot, the reminder is the most you need to do. You don't want to penalize them for being forgetful.
So what is the default rate?
It's on the order of 2% plus or minus.
That's remarkable.
Well, I think
it's meaningfully lower.
Yeah.
It's meaningfully lower than credit cards. By the way, our lower ticket items, that trends below 1%. So just to give you a sense, like the rumors of this being a bad financial product creating hidden leverage in a system is like bad math and ridiculousness.
So push back on that a little bit, but do it through the explanation of the business model here, because I think a lot of people approach this product with being informed about how credit cards work and the idea that high interest if you miss a payment, fees if you miss a payment. In a sense, the risk is somehow put on a different party here, Max. And there's also buy-in from the retailer who partners with Affirm. Just explain how this whole transaction works.
Yeah. Very simple. You typically find Affirm at a point of sale on any online and now progressively more offline merchants. You will ask to use the product. So it's always an explicit request to borrow. And we take great pride and put a lot of technical emphasis on underwriting every transaction individually so that we have the discretion to say, hey, you're overextending yourself. These 2%, 2.5% default rates don't come for nothing. We do an enormous amount of work in this underwriting engines that we've built. So as you get approved through your real-time application, of course, what happens, we pay the merchant and you commit to paying us back over time. And we always give you a menu of choices, could be anything as short as 4 payments every 2 weeks, could be as long as 36 months, once every month. The rest of it happens more or less automatically if you opt into the auto pay feature. If you don't, we will send you a reminder and then you arrange for repayment from your bank account typically. And that is it. In our case, there is no compounding. The interest is the interest expressed in dollars, and that is what you commit to. It will not go up independent of any modifications to the schedule. There are no late fees. In our case, again, we are unique, or almost unique, I think, at this point in the industry by just not charging any incremental fees at all, and so on. And so this really is the product where the cornerstone value is transparency. We are entirely transparent with every participant in the ecosystem, from merchants to consumers. Everyone knows what they're getting into. You get your bicycle or your couch or your putty supply today, and you pay for it over time. And you know exactly when the payment plan stops, and then you're no longer in debt. It is a better alternative to credit cards because when you use credit cards, which are very convenient, you don't have this extra approval step. So, just drop the plastic and on you go. You're adding to this giant bucket of debt that just sits there and revolves. The interest compounds into principal every month, every week. Whatever it is you've accrued in interest becomes a part of the base that accrues interest on interest on interest. That is why credit cards are so expensive. The reason APR matters as a measure is because it doesn't just measure interest you'll pay on a principal, it's the interest you'll pay on the interest, and so on. The model we invented, the reason we are so important, the reason people are coming to us, frankly, is they don't have to understand exponential mathematics to figure out what is the true endpoint of interest will be. Whatever it is we promised them, that's exactly what they pay.
We're speaking with Max Levchin. He's the founder and CEO of Affirm, the $29 billion market cap fintech company. Also, you'll notice Carolee keeps talking about bikes. He's a big cyclist too, so spends a lot of time on the bike.
So is Tim, by the way, Max. Hey,
we know we follow each other.
I know you guys do. hey, listen. One of the things I want to ask you: your stock is on a tear. It's up 50% year to date. It's surged as much as 25% intraday in response to your earnings, which you've been talking about. That came out late August. You had analysts, several of them raising the price targets on the stock. What's the path to sustainable profitability? What do you need to see happen to kind of keep the momentum going?
We just need to keep doing exactly what we've been doing. The joke I make all the time is we are an overnight success 15 years in the making. Profitability is not an accident. We gave this date exactly a year ago where we said, look, 12 months from now, we'll be GAAP profitable. 2 years ago, we said, hey, 24 months from now, we expect to be GAAP profitable. And so we've been on a journey that we've planned years ago to deliver on all these milestones. And so the celebration isn't of some clever overnight idea that we've had and finally just, poked our head from the unprofitable side of the fence. We've been planning to be profitable. We've delivered on this plan. We have said publicly, we intend to be GAAP profitable from this point on. That is not a thing you can decide last week and deliver tomorrow. It's something that you build over a long period of time. It takes discipline, takes execution, takes a great team, which I'm lucky to have. And so I'm not worried about that whatsoever. Whatever we commit to, we tend to deliver on.
Well, speaking of time, it's been a long time coming for Klarna and its IPO, and it does plan that here in the United States. Competition in the space is definitely, Max, picking up. They are specifically rapidly expanding here in the U.S. You've got Sezzle. That stock is up about 7,000% in less than 2 years. There's a lot going on. So how are you seeing the competitive landscape evolve, and what does that mean for you guys specifically at Affirm?
We're very happy doing our thing. As I just extolled for a little while, we are different. We do our thing a little bit differently than the rest of the industry. We have a very strong point of view on what is and isn't moral, what isn't right for the consumer, for the merchant partners that we have. And, it's paid great dividends for us and our shareholders. So in that sense, we intend to change absolutely nothing. Part of why maybe I spend less time looking at the competition than one does in a competitive industry, and this one is certainly very competitive, is in aggregate, buy now, pay later is still just under 1% of total US retail, and it's a worldwide phenomenon. And US is actually quite behind. If you look at markets like Australia and the Nordics, where buy now, pay later is more mature, there the penetration into e-commerce is on the order of 20-25%, I think. In the US, it's a much more polite 7% maybe. And if you expand it into offline, which there's no reason why this doesn't work offline. In fact, we have a card that's been growing extremely well, better than 100% year over year, just in the last quarter's report. We're a fraction of a fraction. So the opportunity to provide more honest financial products is, I said it in my shareholder letter, sort of tongue in cheek, it rounds up to infinity. And so for now, we're not really running into each other in the hallways, fighting for that last same customer or merchant. I'm sure one day we'll get to a point where it's so significant as a part of the U.S. economy where it becomes, a zero-sum game. But even in that world, there's a Visa to a MasterCard. And for now, I think we're all just experiencing really good growth. And frankly, the fact that the market now will support a couple of large publicly traded companies, probably a good thing. That just gives shareholders a sense for this has a long way to go in terms of growth.
Hey, Max, before we let you go, just 30 seconds on crypto and stablecoins. An opinion piece this week coming from Paul Davies of Bloomberg Opinion. He wrote that stablecoins are an opportunity for merchants and airlines to recover costs from big banks and networks like Visa and MasterCard. Is there a use for digital assets at Affirm?
I think there are interesting opportunities around merchant settlement, which is sort of, I'm echoing what this piece is saying. I'm not yet seeing consumers spending stable coins they have acquired in droves. And so as a back-end mechanism, stable coins are very interesting, and we're certainly looking at the opportunities there. On the consumer side, I think folks are thinking in dollars and probably will continue to do so.
All right, got to leave it there. Hey, Max, thanks for carving out some time for us. Max Levchin, founder and chief executive officer of Affirm. Max, of course, just a great voice when it comes to what's going on in the fintech space.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Big picture, we're thinking about sports as a multi-trillion-dollar global industry. We're bringing you influential voices from the business behind sports to help you identify what is coming next. And that's why our coverage of Power Players continues. Joining us for guests right here on set.
All right, let's get to it. Derek Sprague is with us. He's CEO of PGA of Americas and Bloomberg News Texas Bureau Chief. Julie Fine, they're just off their discussion up on the big stage, both of us here at Power Players. I am curious, in that conversation, what was it that, I don't know, maybe surprised you in your conversation with Derek?
I think the part that touched me the most is when I asked him the most unique round of golf he ever played, not on a financial standpoint, but the most unique round of golf he ever played was with his kids.
Yeah, it's always fun playing with your kids, and I don't get to do it as often as I'd like, but it's always special when it happens.
I have to say, I'm one of 7 kids, 4 brothers, and a rite of passage was my brothers learning to play golf. And I'm so sad that I never learned to play with my dad. And it's
never too late, Carol. Never too late.
I know. Talk to us about the golf landscape. It continues to evolve and change. And whether it's foreign investment, a lot of things going on, new formats. Where do you guys fit into the overall ecosystem?
Yeah, so we're the PGA of America, so commonly known as the coaches of the game, the administrators of the game, the club professionals, right? There's 16,000 clubs in this country, and we have PGA professionals at nearly 10,000 of those clubs. So you'll see a PGA professional if you go to a golf course, whether that's a public facility or a private facility. You'll take lessons from our PGA members versus the PGA Tour, which that's what you see on television every week. The elite part of the game is the PGA Tour. However, we work very closely with them because a lot of our PGA members are coaches of their tour players.
Right.
During the pandemic, golf really exploded because it was one of those sports that early on people realized they could do, and it was low or no risk. Have you seen that growth continue?
Yeah, it's been incredible. We haven't used social distancing word in a long time, but golf, PGA of America actually went to bat during the pandemic to say, because as states were shutting down, we said, hey, golf is a safe sport. And I think what we're seeing today, 5 years after the pandemic, is that growth continuing because, as I told Julia earlier, families got together, right? They were all living together. They got to play the sport together. You get to play with your kids and your grandkids in a safe environment, outdoors and small groups, all the things that social distancing lend itself to. And we've seen that retention today. We have more golfers in the game. We're up to 28 million in this country. 550 million rounds of golf were played in 2024. It's just incredible growth since the pandemic.
I mean, I think in terms of the financial aspect of this game, what surprised me a little bit that we discussed earlier is the global impact of it and what a difference global sponsors are making, the biggest changes you've seen in Ryder Cup in that aspect.
Yeah, this year, the Ryder Cup here in a few weeks in New York City's backyard out in Long Island and Bethpage is we have about 280 corporate partners, and 30 of those are from around the world. We certainly have our worldwide partners at the PGA of America for the Ryder Cup, but we have 30 partners from Australia and Japan coming in. They're not even, those countries aren't involved with the Ryder Cup, but they're investing in the Ryder Cup because it's a live sporting event, one of the most epic sporting events in all of sports, not just golf.
How do you think of the role of the Ryder Cup in the midst of what feels like a divided golf world right now? How important is that?
Yeah, I mean, I think we're past that a little bit, Carol, but it's certainly divided when you talk about the Ryder Cup because, it's going to be loud and ruckus on Long Island. The Europeans are coming into our home court, so to speak, and as Keegan calls it, our captain calls it, America's course now. It used to be New York's public course, but it's America's course that week. So yeah, it'll be divided that way. The crowds will be divided, and but I think the investment in golf is now global, like I just mentioned, and so many people. Golf is booming not only in this country; it's booming globally now. More golf courses are being built around the world because of more golfers from around the world that are playing over here in America. They go back to their hometown and home countries and help start the game there.
Since the inception of the LIV Tour, what we've also seen boom is the purses. I mean, these players are making a lot more money because of this really competing tour. What do you see the future of all this?
Yeah, I see it plateauing a little bit. We saw, that was Again, we're different than the PGA Tour, but it certainly increased our purses at our majors. All three of our majors, the KPMG Women's PGA, the Senior PGA, and the Men's PGA, which will be holding at our home course at Frisco, Texas there. So, yeah, the purses have grown, but I don't think they're going to continue to grow at the rate they have in the last few years.
Might you see the Ryder Cup grow beyond the United States?
Yeah, I mean, we play it every other year, so it's only in this country, and I think that's why the demand is so high for this year's Ryder Cup, one being in New York City metro market.
It's a great market to hold an event.
It sure is, and then we'll play it. It'll be in Ireland in 2027,
okay.
So it goes back and forth every 2 years. Just to show you the magnitude, 500,000 people registered for tickets for this year's Ryder Cup. Only 50,000 a day will be coming to it, but 500,000, right? And then we had 30,000 on the list to volunteer. 30,000 say, hey, we'll come and work. We'll buy a uniform. We'll come out there and work. We'll have about 4,000 volunteers out there.
But do you expand it beyond the U.S. and Europe?
No, I don't think so, because
okay.
This event goes back to 1927. We're coming up on our 100th anniversary in Ireland in 2 years, and I don't see that changing at all.
I'm wondering about accessibility to the sport here in the U.S. and how you grow that pipeline, especially for U.S. players. We just went to the U.S. Open last week. We broadcast from there every year, and every year we hear from the USTA about their efforts to increase the ability for kids to go out and play tennis, a sport that oftentimes is associated with country clubs, similar to golf. What needs to be done in the U.S. to increase that pipeline for young Americans?
Well, the PGA of America has been doing it now for over 10 years, and we have a program under our PGA Reach Foundation umbrella called PGA Junior League. We put these kids in jerseys with their names and numbers on their backs. We'll have them out here at Ryder Cup, so you'll see a sprinkle of that, cheering on their favorite players or whatever. But we had last year in 2024, we had 77,000 juniors play. Oh, wow. So our PGA of America golf professionals, they form these teams at their facilities. They compete against other teams from nearby facilities, and then we'll have a national championship actually in Frisco here in a few weeks. So I mean, and that'll be televised on ESPN. So even junior sports are seeing the big time on television, right? So again, our PGA professionals are hard at growing the game, and PGA Junior League is just one of those great programs. Probably the most successful program we've ever had for growing the game.
You have some really big names in golf right now. You look at like a Scotty Scheffler from our neck of the woods. Texas really actually is becoming home to a lot of pro golfers now. But you look at him, you look at Bryson DeChambeau. Overall, you've got a lot of younger players. They're really appealing to people via social media and different means, and you've got a traditional base as well. So how do you marry that?
Yeah, well, I think the younger generation, they grew up, a lot of them, in this video game world. So now technology has helped them get in there. They got range finders and they're checking the yardage on their watches and stuff. I mean, it just connects them to the game. And then when you look at the alternative off-course things like Top Golf in those type of venues, and you got some right here in the city, right? You can go play golf inside the city here at some of the venues here. So I think that's transferring to whether you play 9 holes or play a short course or play 18 holes. All these alternative forms of golf have helped elevate the game, especially with that demographic. And when they go all in on something, and I think other CEOs would tell you this, whether it's a certain product or a certain sport, they're all in. That demographic, they're not doing the mile wide and inch deep. They're going a mile deep and an inch wide. So if they get on to a certain sport, they're staying with it.
But Derek, like everyone is competing for our eyeballs right now. There's so much content out there, and certainly just even sports content. There's so many different choices. So how do you guys kind of figure out how to expand your audiences in a way and then still stay kind of true to the traditional aspects of the game?
Yeah, well, I think that's what the sport does, the multi-generational part of our sport, where you have, right here at Bloomberg, you'll have some folks that have worked here for a number of years. They're mentoring the younger generation. They're taking them out to play golf. A lot of business deals are done on the golf course. So that's just one.
Is it still or is that just a stereotype?
No, it is. And when you think about it, as much as technology is in this environment now, at a lot of the golf courses, it's great to put your phone down and actually talk with someone and just think about having a meeting for 4 or 5 hours. So on a golf course to play 18 holes, you're playing for 4.5 hours. You could be with your boss for 4.5 hours. You could be with a client for 4. You get to know these people, and it's a great human interaction. That's another beautiful part of our sport is that, it's not only traditional, but you have the technology infused with it, but then you get to spend time. And that's why I said earlier, just being able to play with my kids and spend 4 or 5 hours with them is great.
Is it still a lot of guys, though, playing?
No,
have we seen an increase in women?
Women's is the fastest growth of the sport.
Okay.
Since the pandemic, more women have gotten into the sport, not only for recreational. Again, I think being like, hey, when the families were at home and they were shuttered at home, they said, hey, I want to go out and play too. A lot of women took up the sport in the last 5 years. They've stayed in the game, which is great. And then I got a lot of nieces, and they're taking up the sport because they know it's an important part, not only for business, but for family. So it's wonderful to see, and that's one of our proudest moments is to see the sport grow with the youth and with women and other people of underserved populations. Yeah. We have a PGA Works part of our foundation, which really helps grow the game for underserved communities. And we're trying to make the PGA of America is the entity that's trying to make the game look like more like America.
You just talked about the human aspect of this. I'm now going to the not human aspect of this. Great segue. AI, changes in the game and technology. PGA of America, of course, in Frisco, Texas. That's how we know each other. The technology is, you take a shot and it tells you everything that's wrong with it and what's right with it. But I mean, anything to dissect your game, that is there. What is the future of technology in the game?
It's just going to continue to grow. In fact, that's one of the first things I did as the CEO when I got there. I talked to our head of education, and I said, what are we doing? We have all our associates that go through our headquarters there, and they learn the trade and become a PGA professional. Then I said, what are we doing to teach them AI? Okay, not only with the launch monitors and all that, that'll have AI all factored in there with the algorithms and all that. But we're teaching our young associates how to use AI in running their golf facilities. So whether that's doing a flyer that's generated in a couple minutes rather than a couple hours, or doing rounds forecasting for their budgets, or doing newsletters for their club, and using that AI technology to save them time, make it more efficient. Hopefully it'll look better and then impress their bosses and their boards and their members.
One thing that we talked about, again, tennis fresh on our mind as the U.S. Open continues here in New York and as we broadcast from there last week, the average age of a tennis coach here in the U.S. is relatively old. And I'm wondering if you're seeing similar challenges when it comes to coaching with golf. Are you able to get those younger coaches in there who can spend their entire lifetime essentially teaching the game to others? Yeah,
we have three career tracks, really, that sort of like when they want to become a PGA member, which direction you want to go. So we have club operations, we have coaching, and we have executive management. The highest growth is coaching. So we're not seeing that challenge. We're seeing more young professionals want to get into coaching. And I think
why is that?
Well, I think one is it's a good lifestyle, right? You're not club operations can be challenging, right? You're coming to the club at 5 a.m. You might be closing it at 11 o'clock at night. Where teaching, generally is done in daylight hours. And I think we've had such great success teaching players. Randy Smith is one of our PGA members, and he's teaching the number one player in the game, Scotty Scheffler, and we've done a lot of great segments on that. And I think that just inspires our young professionals to say, I want to be like Randy Smith, and I want to be one of the best teachers in the game.
We're talking with Derek Sprague. He's CEO of PGA of America. Also with us is our Julie Fine, Texas Bureau Chief here at Bloomberg News. Things evolve, things change, and things are questioned about. I do remember these conversations we were having that, like, a younger generation isn't playing golf. Is it just the pandemic that you think got people more interested? Like, where
well, that was probably that jump started.
Yeah.
But this sounds self-serving, but I look at some of the programs that we're doing, Carol, like PGA Junior League. We've been doing that for 10 years.
Yeah.
And it's grown every year for 10 years, right? And you're getting 70. So what happens, again, when you look at the multi-generational part of our sport, these kids play, okay, and then their parents, again, what's beautiful about the sport is they don't have to sit on the sidelines like some other youth sports. They don't have to be up in the stands. They can participate with their kids. So all of a sudden you take a couple children and then a couple parents start, and the game of golf grows. So, it's just, I think programs like that, and then we got another great program on our foundation for our veterans of this country called PGA Hope. And these veterans that they're trying to reassimilate back into civilian life, and our PGA coaches are helping them take up the game, building community, and now they're starting to play the sport. So I think all these programs that we do at the national level at the PGA America, plus we have close to 33,000 PGA professionals, one of the largest working sports organizations in the world, PGA of America is. So those members working at these 15,000 clubs nationwide are helping grow the game day in and day out.
Starting to pay it off. We've got one last question. We're going to let you, Julie, wrap it up for us.
Perfect timing. The last question is, 10 years, where are we in the game of golf?
Yeah, well, today we're a $102 billion industry. I see that growing probably by another $20 or $30 billion. I think the retention rate is going to continue, and I think we're going to see, instead of 550 million rounds of golf being played, we'll probably see 600 million rounds of golf in 10 years and just continue to grow this sport. Instead of 28 million golfers, you'll probably have 32, 34 million golfers in 10 years' time. So, again, all these programs are continuing to develop golfers, and our 33,000 PGA professionals are growing the game nationwide. And I think all these programs will just continue to add to the numbers economically in golf.
Well, I got to say, I loved hitting golf balls at the driving range. Like, it was just so much fun. It's just such a part of us growing up. Thank you so much.
You're welcome.
Both of you.
And when are you guys doing the show from Texas?
Hey, anytime you invite us.
I'm on all the time. Let's just do it from Texas.
Bring us down. Lots of family in Texas.
We'd love to
the
have
state.
you.
Derek Sprague, thank you so much
You're
again.
welcome,
CEO of PGA of America. And, of course, our thanks to our own Julie Fine, Texas Bureau Chief at Bloomberg News. We're going to put on a cowboy hat. We're going to come down.
I'm waiting.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Soon to be up on the stage are our next two guests, Alex Rodriguez, Chairman and CEO of A-Rod Corporation, Bloomberg Originals Chief Correspondent Jason Kelly, joining us right now on the newest season of The Deal, and also just to talk about power players. But first of all, Alex, I have to tell you, this is my former co-host.
Yeah.
Before this one.
Okay.
So I feel your pain.
From good to great. Oh, my gosh. Wow. From good to great. Wow. Oh, my. I mean, I'm bidding you up. You have home field advantage here. It's not working.
How many seasons did you last with Jason?
4 or 5?
No, like 2.5 years.
Right, it's a third season. The deal.
Like 5.
Right.
It's a third season. The deal. So Alex is already.
Oh my
made
God!
it longer.
Now Alex and I's marriage has lasted longer than my marriage to Carol. This is amazing.
Wait, okay, now my world's turned upside down.
Yeah.
Well, tell us about the third season. You guys have been working together for a while.
Yeah.
How it kind of has evolved and how you think about who you want to be talking about in this world.
I mean, it has evolved. I mean, we've had a really fun week this week. This is teasing ahead to later in the season, but later on, we're going to sit down upstairs with Justin Tuck, obviously former New York Giant, won 2 Super Bowls. He now works, he's a managing director at Goldman Sachs,
I know.
which is amazing. But we've had a crazy last couple days because and you're going to love this one, Carol, because I know you're a fan of this person. The first was Erica Badon, who is former Erica Nardini. She ran Barstool. She had some incredible stories. And then yesterday, Robin Arzon from Peloton, who you and I interviewed
we did
way back
a while
in the day.
ago, yeah.
I mean, Alex, that was unbelievable.
I mean, she's a force of nature. And what a story, right? To be a litigator lawyer, one of the top firms in New York. And then around 2011 says, you know what? I'm going to do a radical pivot. And she cold emails Peloton, gets the job. And one of the most things, I mean, there's so much to admire, but the fact they've been to the moon with their stock, right? Over $30 billion market cap. And now is, obviously a lot less than that. And she has stuck it through. And we asked her about it, and she gave a fantastic answer. That's my tease for
The other thing that she said, which is so funny. So this is how, I'm going to tell a little bit behind the scenes story. Inside baseball about the deal. And this is how I know that I think the show is really working is we literally sent each other voice memos this morning saying, like independent of each other, saying, my favorite part of the interview with Robin Arzon was this thing that she said. And you'll have to wait to listen to what it is, but that was kind of a cool moment where we basically, in this 45-minute conversation, there was one thing that we were both like, I'm going to use that in my day-to-day life. And I do think one of the things that we've started to achieve with this show is, like, sort of a level of intimacy with our guests. They tend to open up. We had in this most recent season, we had Bill Belichick on, a pretty rare business side interview. I think he told us stuff that, he hadn't really talked about before, and really talked about his approach to coaching, what it's like to sort of take this new job in college sports. And so, we're having a ton of fun. This is fun.
Another fun one, timely-wise, because you mentioned time, is Mark Shapiro's. The day they rang the bell and they took TKO public. And he gave us some fascinating stories going back to the Bob Iger days and what he was doing at ESPN and how he was a rising star. And now he's obviously the president of TKO and Endeavor. So many great stories. Yeah. And now people are starting to reach out to us and saying, hey, can we be a guest?
That's what I was going to ask, Alex. Now that it is the third season, you're not necessarily having to knock down doors the way you guys did just 2 or 3 years ago in order to do this. How are you thinking differently about the conversations and who you want on the program?
Well, I think Jason reminded me yesterday that we've done around 50 shows. Wow. So we're getting some reps. We're getting out there. We're dropping one every week, which is the consistency is key in podcasting and anything, just like your job here. And I think we're thinking bigger, and we're thinking, how do we think outside the box? How do we storytell? But I think Robin from Peloton was like the epitome of everything, right? You have a lawyer who's now in fitness, who's now, one of the most influential fitness people in sports in the country.
Well, and I think, to build on what Alex is saying, I think one of the key things that we think about with our show, and honestly, infuses everything we're doing today with Power Players is, from the beginning, and this is why I think, Alex really bought into our shared vision of this, is we're talking about the intersection of business, sports, and culture. And I think, there's a fair amount that's being done around business and sports. It's undeniable what's happening there. But I think, and we just literally talked about this on a panel that I moderated with Tom Garfinkel from the Dolphins and Mike Garrighetti, the CEO of Aries, this amazing cultural impact that sports has on everybody's lives at a time when we're so polarized, we're so divided. Alex is, very involved on the board of University of Miami. University of Miami beating Notre Dame at Hard Rock Stadium last weekend was an unbelievable moment, in the broad culture. It really was incredible.
Yeah, and it had a huge number, around 13 million people.
Right.
And that is a huge number, right? And it's one of these things, especially after COVID, I think, and Tom talked about it in your last panel, that people still want to come together in a stadium. To have 75,000 people cheering on. Remember the old history, bringing the old days back for the University of Miami, convicts versus Catholics, right? It's pretty awesome. And the fact that we won, I'm very, very happy about that.
We're speaking, of course, with Alex Rodriguez, chairman and CEO of A-Rod Corp. Also, Bloomberg Originals chief correspondent Jason Kelly, talking about the newest season of The Deal and more. Is that culture around sport today, is that a lot different than it was when you played?
Oh, there's no question about it. I think Michael Garrighetti was talking about, 10, 15 years ago, the ownership landscape looked a lot different. A little bit, his words, a little bit more sleepy, and I'm paraphrasing. And the sophistication with the newer owners that have come in, with the ability and the appetite to take risk, while still being disciplined. But, it takes a certain amount of, a cowboy or a bit of a poker player to innovate and keep pushing the envelope and making these assets a moat. But then there's all the businesses around, whether that's a stadium, networks, what the Atlanta Braves have done is incredible. They did $75 million of extra cash flow for the team. I think that's the new model moving forward.
Thank you for mentioning the Braves. That was very nice. But one
Atlanta person here. We should know it for everybody who doesn't know already.
But one thing,
smart co-host.
So smart, so thoughtful. But I'll sort of toss it right back in the sense that I do think, to answer your question, Tim, one of the things that's also changed is in these years that we've been doing this, Alex has become the majority owner of an NBA and a WNBA team, and I do think being able to, we talk a lot about, in our partnership, sort of the roles that we play in the conversations that we have with our guests. And I think Alex's now ability and curiosity and willingness to essentially say to people, whether it's Robin, whether it's Erica, whether it's Ted Leonsis, who's been on our show, whether it's Belichick, to be like, hey, listen, I'm doing something new. We had Sue Bird on our show, WNBA legend. To be able to say, listen, I'm doing something new. Help me understand this new job. That I do think that sort of unlocks something. Yeah. Do you agree?
For sure, and especially they just handed us the keys about call it a few months ago. And it's fun for us to think we just brought in a new CEO in Matthew Caldwell, who was formerly at the Florida Panthers, worked for my great friend, mentor, Vinny Viola, who's won 2 titles back-to-back. No, it's just really the other thing that has changed, Jason, I think, is now we've brought institutional capital into the game. And if you think about the 92 professional sports team, when you include the 4 major leagues, NBA, NFL, NHL, and then Major League Baseball, that changes the whole landscape of the ability to find some liquidity, put that money to work, and keep growing these assets.
You know, I think there was always the worry, though, and I pose this question to both of you, of a lot of money coming in, gambling coming in, what that does to the sport. Has it, let me start with you, Alex, has it changed sports overall, all this money in?
There's no question. There's a new data point that came out that blowout games in the fourth quarter in the NFL were doing better numbers in the second and first quarter. And that's because of fantasy football. And the interest level that is no longer about the score. The NFL has found another hook to, like if they needed one, to bring in more fan base and become even stickier. I thought that was fascinating because most people in the fourth quarter, if it's a blowout, they're done.
Net good?
Yeah.
Well, it depends.
It's complicated.
It is complicated. Look, and there's regulations, and you have to obviously put guardrails around everything.
Right.
But I mean,
or money in college sports.
So I think so. That's the one. So that's the
different.
one that I think is probably. It was funny. I was talking with the athletic director of Ohio State, who was here on a panel earlier.
And we have Dartmouth's athletic director joining us in just a few.
And what I said to him, which he did not disagree with, is what has happened in the business of college sports over the past 5 years is the most radical thing that has happened in any sport in the past 100 to 200 years. I mean, there's no question. Because the entire business model has changed. The amount of money coming in has changed. I mean, even the idea. So let's use University of Miami. University of Miami, the reason they won that game, almost, I mean, not completely, but a huge part of it is because the former quarterback of the University of Georgia was done playing at Georgia. He was headed for the NFL, got a call from the University of Miami and said, hey, bro, hey, Carson Beck, we'll pay you $4 million to come to University of Miami, which was probably 4x what he would have made his first season in the NFL if he got drafted. And then he goes down, plays in front of a bigger crowd, in front of a, you know, in a higher profile game, higher viewership, you know, than he would have gotten if he had even been on the field in the NFL. That's a radical different. Like, that's complete. That
it's a game changer.
It's
is it a good
absolute
one, though?
game changer.
Is it like, or who
so,
knows?
I mean, listen, I think if you, it depends. If you're an investor, there is certainly a lot of investing to be done around it. I think there, to Alex's point about guardrails, there need to be new guardrails. You know, one of the things the athletic director said was, like, we are literally making this up as we go along, which is crazy. I mean, like, none of us can do that in our jobs. And it's like, I try, as you know, but like, we can't actually do it.
Yeah, I mean, imagine any league without a collective bargaining agreement, right?
Yes.
Without a union, without what is the exchange? If you sign a player for 5 years guaranteed, he can't just go on to the opponent over there, the rival. So I think, especially with the young kids, I mean, look, I have a junior, a girl who's a junior, and a young lady that's a junior at the University of Michigan, and I have a senior this year in high school, and I couldn't imagine one of my girls getting $5, $6, $7 million today, and they're not equipped for it.
Right.
Yeah.
Well, and the other thing, and to your point, Bill Belichick on our show said this is actually harder than coaching the NFL because it's free agency all the time.
All the time.
So the kids can move around.
Yeah.
And they will move around.
Yeah, we were talking about the portal with a colleague.
We were talking about it with a colleague here.
Yeah. His son can just log in to a portal and go somewhere else.
And he is going to move somewhere else.
And if you look at some of the great coaches that we've lost from these institutions, whether you go to Bill's, you go to Saban, Nick Saban, you go to Coach K, you go to Coach Wright from Villanova, a tough name for my Georgetown buddy here to hear.
My God.
But I think one of the reasons they're leaving is if you scream at a kid, he's going, I'm out, I'm going to Georgetown, or I'm going to University of Miami. And that wasn't the case back then.
So what does this do to the pipeline going into the pros right now?
I think college football becomes NFL junior.
Yeah.
And I think it really just becomes an extension, and so you start to what it could do is you could have more, in some form or fashion, Carson Becks who opt not to go to the pros because they're going to make several $1 million, you know, playing in college for an extra year, and then I mean, big time football is going to just get bigger and bigger, and college is going to be a part of that.
So, Alex, I'll ask you the same question I was asking you about sports gambling. Net, is this a good thing?
It's interesting, right? Because I still remember the days with Pete Rose, right? I think the answer we don't know yet. I think depending.
But for college sports,
for college sports. I'm not sure about that, but I will tell you one correlation. If just to back up what Jason was saying is, you've never had companies stay private longer, whether it's Stripe or whether it's many examples. I think you can have an example of players staying in college longer because they can develop. They can go to the University of Miami for a senior for $4 million. The kid over at Michigan, the quarterback, $12.5 million.
It's amazing.
So it's a different world.
Yeah. So 8 years in college and still no MD degree.
Ouch!
Wow.
But they got a lot more money.
Yeah, they got a lot.
And no student loans.
We just got a few seconds left here. Got a dream guest that you still guys are like, if they're listening? Real quick.
Roger Federer.
Oh,
good one. Roger Goodell.
Oh, good one.
All right.
Couple of Rogers. Listen up.
So Rogers, if you're listening,
Roger that.
Get ready. Well done. Guys, thank you. Good luck on up on the big stage. We know you're getting ready to talk to Justin Tuck. All right, of course, Jason Kelly, Chief Correspondent, Bloomberg Originals, Alex Rodriguez, Chairman and CEO of A-Rod Corp. They are the co-hosts of The Deal, the third season. It is underway. You can find it wherever you download your podcast.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.